Hey everyone, it's David with Green Mountain Advisors, and today I have Juan Espinoza with JE Fundamentals joining us. Juan has over a decade of experience working at Oak Tree Capital Management, handling distressed situations. He's done angel investing with Harvard Business School. He's been a founder and CIO, and today he's going to share with us his background and his life story and how he became who he is today, what JE Fundamentals is all about, and what we can learn a little bit more about in the distressed investing world, because it's kind of like the what would you say, it's kind of like the special forces or the guys that you don't really hear about in the corporate world, but a lot of turnarounds and things that are pretty magical happen in that space. So it's a pleasure to have you on.
Thank you, David. Good to be here. Ready to go and happy to delve in some of these subjects that are, at least to me, so interesting, especially alternative investing in general and value investing. And, the way we think about it in the distress world is that distress investing is just a form of value investing.
Mm. Yeah, I couldn't agree more. But how did all of this start? How did you get your kickstart into the world before going into Oak Tree and
Mhm.
all these other incredibly sophisticated institutions?
Yes, I was just doing the math on how long it's been since I started investing professionally, and that goes back to 1997 after I graduated from Harvard Business School. And my first passion was for doing equity investing, and I did that for a good number of years. I would say probably almost 15 years. And after that experience, I had the opportunity to join Oak Tree Capital in 2013, and that was pretty straightforward distress investing and credit investing type of career. So the way it happened to me was that I was an equity investor, as that's a pretty common field of investing in on Wall Street. So there's many people that are out there doing that. And during the financial crisis, it became evident to me that one way to make money was to identify situations that were deeply, deeply mispriced because people were very concerned about the survivability of the business, and which is what happens in distress situations. And coming especially from equities, which is a place where it's very, very hard to have a differentiated view about anything. Most, especially large and mid cap stocks, there is already a lot of people covering that, especially now. Even on YouTube, you find many experts on companies, many of them extremely competent, as competent as some of the ones that are professional on Wall Street. So back in those days during the financial crisis, I spotted many opportunities that looked pretty interesting, but were extremely obscure because to do distress investing, you do require a set of skills that takes a while to acquire and practice. So we can certainly get into some of that as well.
Yeah, and as a primer, what would you say are the two biggest differences between traditional equity investing, especially when you're covering a mid cap or large cap stock, versus going into distressed, which to me always sounds like a micro cap or small cap situation, right?
Not necessarily. Well, distress is really, it can encompass any size company that got into financial trouble.
Hmm.
And, certainly it can be relative. I would say that very small companies, usually there are people who participate in those distressed markets, but most institutional investors, especially companies like Oak Tree, like Apollo, like, KKR, some of those, they probably don't get into the micro cap world. They get into the large cap and mostly the mid cap spaces in terms of size of targets. Just to get back to your question, the differences to think about the differences, let's talk about the similarities first. I would say investing in value stocks, usually, going back to what I was doing, I would look for mispriced opportunities, things that other people were probably seeing but not properly appreciating. In the world of distress, you also run into mispriced opportunities, mainly because something so bad as bankruptcy or the high risk of bankruptcy has taken place.
Hmm.
People are pricing in pretty much some of the worst scenarios, such as, this company will never survive. We're just looking at the carcass, what's the real estate value, maybe the building value. Like, people go extremely negative in terms of how they assess the value of the surviving entity, if there is a surviving entity. But a lot of times, through financial engineering of various forms, those companies can come back to thrive and do really, really well. And as a value investor, investing in distress, you can really benefit. But I would say the greatest difference is how you go about it. In terms of identifying opportunities, both are similar. You're just looking at what's out there in the market. Usually when it comes to value stocks, most people have an idea of what names are trading at low multiples, what names have really lost valuation significantly, therefore they look quote unquote cheap. And in some cases, what names are great companies that just the market hasn't paid notice yet. But in distress, a little different. Companies that are at risk of distress or already in distress are typically a relatively short list. Everybody knows who they are. Any data source online or any data source for professionals on Wall Street will help you find those names in 5 minutes. You can also look at the bond markets, which companies have issued debt that used to trade at yields of, say, 7, 8, 9, 10%. And now they are trading at 18, 20, 30% yield because people are basically assuming those bonds will get repaid at a fraction of their claim value. Mm-hmm. So the way you go about it from there, we can get into more details, but it's just more complicated. There is court proceedings. There is negotiations with bankers, with investment bankers, with the company management. Sometimes there's a need to step in and hire management as an investor in the debt. Sometimes the debt investor becomes the sole shareholder. There's various iterations, various ways in which the situations can come to pass. But I would say those are the high-level main differences.
Do you think a lot of this or the framework depends on how you approach the capital stack? You mentioned financial engineering. Mm-hmm. And, for our firm, what we like to do is if a company can't pay its debts, we'll convert it to equity at a certain markup. That's one of the ways we've been able to manage our failures as an investing enterprise. But I'd love to hear like how you think about or how you approach the subject, because it's so dense and there's so many ways of doing turnarounds and how you can approach it as an investor. I'd love to hear more about how you think about it.
Absolutely. I think the number one aspect of investing that works in distress is making sure that the intrinsic value of what you're looking at is deeply discounted when you're getting in. For example, let's say that you're getting into the debt thinking that it's definitely going to become equity. You definitely want to make sure that you're in a position to be converted into equity at a deep discount of what the future equity value should be. If you're going to be repaid, let's say they owe you 100 cents and you're going to get paid 100 cents on the dollar. So sorry, you're owed 100 cents on the dollar and you're going to get repaid maybe 70 cents on the dollar. Hopefully you're buying that debt at a deep discount to those 70 cents on the dollar, because to you, the intrinsic value is 70, no longer 100. So wherever you are and whatever you're doing to participate in that transaction, you want to make sure you're participating at a discount to what is ultimately going to be, and a sufficient discount that ultimately at your exit, your rate of return is satisfactory for yourself, your clients, etc. So having said that, I would say that there are two ways to think about it. One way is that there are situations that are similar to others, and they tend to fall in a certain category. And for example, you would say, well, companies such as this one. Let's talk about, for example, airlines. A lot of airlines got in trouble during the pandemic, and some of them around the world, and many of them ended up getting rescued financing. They went into some form of pre-packaged bankruptcy or avoided bankruptcy because they approached the creditors right before a bankruptcy had to be filed. In a lot of those situations, you could argue the solution was relatively similar. And as an investor in those types of situations, you may go in with a preconception of, it's very likely to happen in this particular way. However, one has to be really prepared for nuances. It could be regulatory nuances, employee relation nuances, value of the assets nuances, especially international companies. They tend to have very valuable assets in different jurisdictions. Each jurisdiction will provide a creditor rights that can be very, very different. And based on such a layered, such a layered set of conditions, one is probably better off thinking that every situation is going to be its own animal, as they call it. So one has to be really prepared to be creative, to tap into legal counsel at the right time and in the right place. For example, the best lawyer in New York may not be very competent to help you if the assets are, say, in Brazil or in Uruguay or in Africa. And that, I would say, that is the answer. Every situation is going to be always a little bit different. And one beautiful thing about that I found in the distress industry is that there is a lot of humbleness. And what I mean by that is that in equities, I find that a lot of people consider themselves experts in their industry that they follow. You know, somebody's been following, I don't know, mining companies for a long time. They very rarely talk to experts. They really feel like they know what they are doing. They'll talk to experts sometimes, but in the distress industry, everybody really has this idea that I need to know more than the other investors who are looking at this. So I'll do whatever it takes. And there is a strong predisposition to hiring advisors, consultants, local counsel if the jurisdiction is different, etc. And I love that because that gives the investor the ability to really have a knowledge advantage, or at least a knowledge competence, which is the very minimum you should have in that field.
Because at scale as well, you're talking about something that might be listed publicly, but now you have to go boots on the ground and actually do the physical research that's involved with speaking to all these experts and professionals. And it must be psychologically so crazy to see the asset constantly get traded, and you're almost racing against the clock to find out what you need to find out to make the right investment. Do you ever, and naturally this might be different in public and private situations, look to create a different financial product with the business that you're looking to make a deal with, or how do you kind of approach it when in public and private situations?
Well, in public markets, the intellectually demanding for sure, and fortunes have been made and created and destroyed in public markets many times over in every cycle. There is definitely a need to be an expert.
We're back. Yeah, due to international terrorism, the Wi-Fi has been down.
Yes. But I was answering your question. I think you were asking me about how is it that each situation gets figured out, given that in public markets you may have one approach that always works, and perhaps in distressed markets there is a different approach that tends to work. Yeah. So let me pick it up where we were. The way I think about the biggest differences between public markets and I would say private markets in the case of distress, and I could say private because usually when a company is in high risk of distress, the equity value will drop significantly. In some cases, the equity gets delisted or suspended, assuming there is an assumption that the equity value is either zero or very close to zero. Then you have the debt value collapses as well. A lot of times the yield on the bonds expands tremendously, and the bonds become very liquid. So you could argue that there is a semi-private market situation that develops. The other reason to think about distress as a private situation is because if the company needs new money, meaning either new equity or new debt to survive, which will be figured out during the negotiations and bankruptcy proceedings, usually that gets resolved in a relatively clubby fashion, meaning the people who are already involved, meaning a lot of the existing creditors, the shareholders, existing shareholders. If there is a founder, sometimes it might be the founders and his family or her family. That's where a lot of the issue gets resolved. It doesn't tend to get resolved through an IPO or a major debt offering in public markets. So it's a private setting. And then in public markets, well, we know how that works. I would say the biggest differences in terms of how to think about making money is that in public markets, there are obviously millions of approaches on how to make money. But from a value investor standpoint, there are two main ways to make money in public markets. One is to identify a catalyst that will take place at some point in the future that will unlock the value. It could be a new product, or maybe the company just becoming more popular, better well known, or it could be, just business success of some sort, and or a value revelation, meaning that there was this long nurtured new initiative that finally bears fruit, and the company succeeds and makes more money, or at least the value is revealed in some form. And and then the other way is just being patient. Simply, maybe there's no magic bullet, nothing is special is going to happen. It's just simply something is deeply undervalued because people don't appreciate it, assuming over time people will appreciate it more, and that's how you make money. In private markets, such as in distress situations, there is more of design. There is a more careful design to it. That's why I used the term financial engineering earlier. There is this idea that each business, depending on its own cash flow or value, has an ideal capital structure. In some cases, the ideal capital structure is all equity. And that happens a lot in distress because you don't want the company to be under the pressure to have to repay debt too quickly after emerging from bankruptcy. So as you were commenting earlier, the capital stack might be very different emerging from bankruptcy, and maybe a few years down the road, the company will be in better shape and they'll be comfortable raising some debt or doing anything along the lines of having debt in the balance sheet. So there are very significant differences. But in the case of distress, a lot of the design of that capital stack happens in the context of a negotiation. Multiple parties will have to agree, and I'm talking about the shareholders, the debt holders, all the people who are involved in the bankruptcy process, the judges who oversee the bankruptcy as well, and the many lawyers who oversee the many financial advisors that get involved. All of them will have to agree that there is a specific capital structure that makes sense for the business right now, and it all is based on a valuation, on a forecast for how the business is going to perform. A lot of variables, different industries will be seen differently, but that's kind of the rough contours of how it happens.
What typically happens in terms of the internal management or the executive team that was running the company before the situation unwinds? Do they usually get separated out, or are creditors working with them to fix the situation?
Mm-hmm. There is a wide variety of solutions to manage the management problem if there is a problem. There are situations, I guess we have to separate perhaps the categories, and I won't get into too much detail, but when a company is in trouble, it could be for reasons completely outside of the control of management. For example, if there is a natural disaster or an issue like COVID, certainly you couldn't blame COVID on any given management team. Things like that, it's very likely that management will survive, unless there is a significant change in ownership and the new owner of the company, perhaps a distressed investor who converted the debt into equity, has a completely different vision for the business, and the existing management is not a good match for that vision. In cases like that, there is a change. If the management was extremely incompetent and they certainly run the company into the ground, it's very likely that management is going to change. And it could also be that there is a change because the company, in order to survive, requires a significant change in direction. And there are examples, for example, that companies that were in the retail business but had a lot of real estate holdings as part of being in retail, maybe the future of the company really has more to do with the value to be unlocked on the real estate side, and the retail side is going to be mostly let go of. You could look at the histories of Toys R Us, of Sears, and companies like that. A lot of the value was seen in the real estate, so it's very likely that the management for the future had to be more of an expert in real estate than in retail. But and also, I would say at least the breed of value investor, distress investor I come from, the mentality is, let's look for great businesses that have balance sheet problems, but not necessarily business or management problems. So the idea is that we can work with the same management team. It's less desirable to have to go out in the world and find a better manager, and because that usually signifies that the problems are probably a lot deeper and a lot harder to resolve. it can be done. It happens a lot, and it depends probably the flavor of the investor who's looking at it. The heritage I have, the pedigree I have, comes from investors who tend to look for situations where it's probably not really necessary to bring in new management unless something happens along the way.
And how do you look at risk management? Because I have a quant background, and a lot of what we think about is expected value and fat tails. But you're as a distressed investor, you're committing a lot of time, energy, and resources, and almost concentrating on a select handful of companies. So how do you kind of balance out the risk of just investing in the same time period and say having too many bets in the same vintage year over the broader scale of the portfolio to make sure there's no crazy variance?
Absolutely. I would say there are two categories of risk that, for the most part, in distress investing, that when you're more at the level of portfolio manager, you have to think about. Certainly, one is the investment specific, like we're investing in this particular company and we have to manage the risk of this particular investment. Let's put that to the side for a moment. Then there is the risk of the portfolio. It's very likely, I believe that most distress investors, certainly the ones I've known directly, tend to have concentrated portfolios. And the way the risk is managed is simply by generic principles that are, I say simply because the principles are simple, but obviously there is a sophistication in putting them into practice. One of them is, for example, not over concentrating in a specific industry. I brought up the example of airlines. You wouldn't want to have mostly airlines in your portfolio during the COVID crisis, because during the crisis you could invest in those companies at very advantageous valuations. But what if that COVID crisis lasted 10 years, not 3 years? Then your portfolio would be in a difficult situation. Or too many energy companies, or too many of any given industry. So there are limits per industry, limits per issuer. That is one way to manage risk. Then there is the generic idea that each investment has to be made at the lowest possible price, or at least at a very advantageous valuation compared to what we think about the exit. And the exit is estimated, and the value of the exit rather gives you the ability to estimate the returns. And there is this popular measure, you probably have seen it many, many times in your own career, which is IRR, the internal rate of return, which is an annualized number for however many years it's going to take you to monetize. Usually distress investment can take a few years to become a real return in your portfolio, because you could be tied in court for a while, or the business itself could take a while to recover. So that is one aspect. At the portfolio level, you have to control your exposures, your sizes, and all of that. And it's very unlikely you're going to see a lot of derivatives trading to hedge portfolios at the distress level. One of the beauties of distress is that if there is a lot of problems in the portfolio coming in, it's probably because there is a kind of economic macro level source of distress. For example, there is a recession going on, and there is a massive shift in interest rates that has affected a lot of businesses at the same time. If there are reasons like that, what that means is that a wave of distress is getting bigger and bigger as an investment opportunity. And at least the better investment managers out there, so some of the ones that I work for are a good example, have the ability to go out to their investor clients and tell them, hey, we're seeing a lot of distress coming, and this is going to allow us to deploy a lot of capital. You probably should give us more money. So I would say, unlike many other aspects of investing, when there is a wave coming of bad things, distressed investors tend to salivate, because it allows them to raise more money and increase the AUM. So there's just kind of a side thought to it. Then just going back to individual company. In individual companies, the first premise is getting at the lowest possible price. And that is the main hedging factor, or the main risk management factor. The second risk management factor is to have a seat at the table. So depending on how big your position is, how significant your situation is, you are as an investor, where you are in the equity or the debt, you may or may not have an ability to influence the decisions that have to do with how the distress is getting resolved. There are going to be many negotiations with financial advisors, lawyers, the judge, et cetera, et cetera. And having a seat at the table allows you to influence how the financial engineering of the final solution will come together. Not having that at your disposal puts you in a very difficult position as an investor. So distressed investors tend to only get into situations where they feel they're going to have sufficient capital to have a position that will give them a voice at the table. So I would say those are the most significant risk management factors.
So with JE Fundamentals, what are you trying to achieve after, over 2 decades of experience in the field, working with probably the best investors out there? What impact and what is the whole mission behind what you're doing now?
Absolutely. So in December of 2023, I would say it's most definitely a few months before that, I communicated to my colleagues and supervisor that I was going to be stepping away and essentially retiring from investing. And it was a decision that was, at the moment, was hard, but now I'm very happy I did it. Of course, there was no need for me to run away or step away necessarily for business reasons. It was simply, I had decided that what was coming for me professionally was just kind of doing a little bit of the same that I had been doing for 26 years altogether as an investor. And I wanted to do something different, something that allowed me to give back to this industry that had been so wonderful to me. So after a lot of thought, what I decided to do with the next stage of my career was to help people who are getting started in this industry. And maybe I need to just get back into my personal story and why and how difficult it was for me in the beginning to enter this industry and to feel that I was achieving some level of success in this industry. Part of the fact is that I wasn't born in the US. I was born in Peru, in South America, and I went to Harvard Business School, which is a wonderful school to go to. But I entered Wall Street without knowing anyone, without having any mentors, any network or connections. And I was able to build some of that over many years and reap the benefits of having what I think was a very well thought out career strategy along the way. But it wasn't something that came easy. It took a lot of effort, a lot of trial and error. And along the way, as I became also a supervisor and managed analyst myself, I noticed how there is so much talent that enters the industry. But a lot of talent also leaves the industry prematurely because they don't have the ability to think about how to add value consistently, how to present themselves in a way that creates brand equity for themselves as individuals, and how to contribute in a thoughtful way that leads them to succeed long-term in the industry. And not always you see that the ranks are filled necessarily by the best people. A lot of the time, the best people end up leaving and go to something else. So when I left the industry, I said, so when I look back at my last 25, 26 years of my life, what do I feel I can give back? And I just realized that a lot of what I had to give back was to put to pen and paper and in digital form a lot of the ideas of what is it like to have the correct mindset, the correct career strategy to become successful in this industry. And that's where I decided to create JE Fundamentals. And what I am doing in this context is creating digital products that will teach analysts who are probably in the first 5 to 10 years of their career still how to think about what they do, how they add value, and how can get the most for themselves out of the industry, and at the same time becoming great contributors. So that's what I am doing now.
So you're very focused on the 5 to 10 year mark. What do you think? What makes the difference between like a 1 to 5 versus a 5 to 10? Just being in one full business cycle, or a certain position in the ecosystem? What's the reasoning behind that?
I think in the first 5 years, I mean, it's not a set rule. I would say the first decade is my focus. But what I see in the 5 to 10 number is the fact that usually after a few years in the industry, people have a greater understanding, number one, of the industry. They've already had sufficient successes and failures to understand what they got into. And they probably already realize that they need some help. And I can look at my own experience and the experience of other people that I've known over the years. In the first 5 years, you have so much motivation, so much just intrinsic courage about what you're doing. And you're so marveled at the beauty of capital markets and all they have to offer. You see, you probably have friends who are already becoming successful, making lots of money. There's a certain blindness because the lights are shining so bright in your face that you are a little bit blinded to what's really out there, the challenges, the opportunities, etc. I find that after perhaps 3 to 5 years, you're already beginning to realize that this is we could call it a game, but it's a game that has very specific rules. And to become successful, trial and error is just way too inefficient. It's too inefficient because you could make only 1 or 2 bad decisions that set you on the wrong path. And conversely, if you, in those first early years of your careers, in the first decade, you can make decisions that will set you on a very successful path. And without getting into a great number of details, I would just like to say the first decision that has to be made correctly is working in an investment field that's a good match to your temperament and to your skill set. For example, if you're a very quantitative investor, that's just an obvious example where you probably need to be a person who has affinity with numbers and who doesn't think looking at numbers and numbers and numbers all day is necessarily boring, who has the ability to connect facts of the market with a table full of data that other people would just be put to sleep with it. And there, I can give you various examples. For example, in capital markets that are private, usually you don't have the feedback of pricing every day. So that dopamine hit that some of us crave is not going to be available in private markets, but it is available in public markets. And there are some individuals who really need that energy of seeing something happening every day, the prices moving up and down, that feedback, the ability to put option trades, to do equity trades, to do whatever trades they want to be doing, and then the action has to be happening constantly. That is a very different individual from the individual who is going to negotiate a capital structure for a transaction that could take 6 months to complete. And the same, we could say the same on private equity. Private equity can be a really long process before you can monetize the profits. So if you are able to understand yourself properly and identify what is the field in finance and invest in the best fit who you are as an individual, you're going to get 2 things right. Number one, it's going to be easier for you as an individual to make contributions to the team you're in, which is obviously the best predictor for career success. And second of all, you're going to be able to improve over time faster than a person who doesn't have that kind of affinity. So there's this dual benefit. Not only you are naturally good, you can also improve better, easier, and faster than others. That has a compounding effect over time in your career that is it's going to be very hard for other people to catch up with you. By the same token, if you are in a field that is not a great match, and on top of that, getting better is harder than for your peers, you're going to be falling behind, and it's going to become noticeable. And hopefully you don't have to wait 10 years to figure that out. Hopefully you can figure that out in the first 5, definitely in the first decade of your career. And that is the premise under which JE Fundamentals is working on these days.
Yeah, and it sounds like for both fields, of course, there's a high degree of creativity where, even in quantitative finance, I find that people rely a lot on models and not enough on looking outside the box and saying, okay, this is just a model. And one of the things that has drawn me, I would say more so in the past 2 years, away from quant finance and more into private equity and these types of special situations has just been the ability to connect what's going on publicly with what's actually happening in the paperwork. And then how do you structure the transactions and actually create something that could be theoretically productized in the future? Do you find that creativity is increasing or decreasing in the space because it is kind of a mature field overall? Mm-hmm. Now with the addition of things like AI, there's more ways for a machine to do more of the mundane stuff. So how do you kind of look at that intersection?
My strong belief is that investment management and capital markets in general are, alongside tech are one of the strongest drivers of innovation. There isn't a year in which you don't see a new trend driving capital markets in some new direction. And in the last few years, for example, private credit has become a massive force in capital markets. And a lot of very large private equity investors you've seen have built significant credit arms. So I strongly believe that everything we're seeing in AI and in many other areas is just going to contribute to innovation in capital markets in general, and most certainly in investment management. And that is needed because you have aging populations that are going to retire en masse. You have situations in which, for example, the banks are not participating as lenders. And in the old days, any business walking into a bank, the bank was always the Goliath and the business was the David. The business had to try to adapt itself. So, we have these three options. We either borrow money for 1 year with a line of credit, or maybe for 2 years with a loan of this or that kind. And then they also have this 10-year loan collateralized, which we have to sign our lives to the bank, and we may lose everything. In the old days, as a medium to small business had very few options. But now with private credits becoming such a dominant force, we're going to see, the same thing you see in media, which is almost like media is, and YouTube is a perfect example of that, how media has become really tailored to almost down to the individual, right? And now down to the mood you are in that moment in the day, you can find content. And capital markets is quickly becoming the same. Every company is going to be able to borrow money based on its own cash flow needs and cash flow. Maybe it's going to be a zero cash flow company for 1 year, but then in year 3, it's going to be massive amounts of cash flow. Traditionally, a lot of companies in that situation couldn't find the financial institution that had the patience, the ability, or even the desire to understand them deeply enough that they could lend them considering that stream of cash. But what we're seeing now is that private markets are becoming run now by investors, and they are also, I'm talking about private credit, of course, investors that have the means and the willingness to look at every situation with a fine comb and develop a financial solution that's special for them. So that's just one example that I'm diving into because I'm familiar with it, which is so satisfactory to see how innovation is just making it easier. And I think technology makes it easier too. You can have now very sophisticated investors. They can use technology to serve clients or borrowers who normally they probably would not have had the ability to look at. So I could give you more examples, but those are two that are coming to mind in the moment.
There's like far more flexibility, creativity, ability to democratize capital in a way where it wasn't available before.
Absolutely. And one thing that is very near and dear to my heart and may not be super relevant to everyone is the thought that in the old days, investment management firms had the research departments, and there's this idea of the head of research. I myself was a head of research for my team, and then you had the head of research thinking strategically what is the best place to put our brains into in terms of where are we going to be identifying the next investment opportunities, what should be our focus. With AI now, you have the ability to have every analyst become like a head of research, because with the help of agents, with the ability to manage so much information at the same time, to analyze, in 30 minutes, you can analyze the transcripts of 30, 40 conference calls and come up with the most important conclusions of that. Normally, that would have taken several days of a bunch of people. Now, one person can do it in less than an hour. That is amazing. So I think the future, at least as far as I can see today, it may change in the next 5 years. Every individual analyst can become almost like the head of research. And maybe one day they can start thinking within 5 years of working, they can already start thinking as a CIO, thinking, how should this portfolio be allocating risk? Should we be taking advantage of the greatest opportunities out there? So the individual is becoming empowered to make contributions that normally would have taken a large group of people to make. So I think it's only good news.
So does it seem like with the speed to information discovery, price discovery will increase faster as well, and volatility will kind of shrink as things develop, or are markets just always going to be this chaotic? I know that this is a very theoretical question, but I'm
Of
sure.
course, of course. Well, I think the market, the way we make money in capital markets is by seeing essentially is by seeing what other people can see. So we are the first ones to see it, or at least the one of the few who can see it. Mm-hmm. The other way to make money is by being very, very fast. You see algorithmic trading, for example. The speed is so important, speed to market. I think speed to market will end up affecting everyone. For example, in a few years, a corporation will say, I need to borrow $1 billion, and there's going to be a number of people able to give them $1 billion, a number of institutional investors able to do that. And the one who can do the diligence the quickest and come up with a solution the quickest is probably going to be the one that ends up lending the $1 billion to that company. In the old days, it was a very predictable process. Hey, there's a data room, there's negotiate, sit down, give me your proposals in the next 60 days, and we'll close the deal a few days after that. As we go into the future, that process shrinks, so speed becomes important. And to answer your question, we're talking about volatility. I think volatility will always exist mainly because the most interesting investment opportunities will be into things that are hard to understand. Perhaps to invest in everything that exists today.
Could you repeat that last part? I think we cut out from the.
Yes. Today. So yeah. What I was saying
with the volatility.
Yeah, exactly. So in my mind, volatility usually exists because information changes and there is an uncertainty element into the future. And for volatility to disappear, uncertainty would have to disappear. And I believe that uncertainty is very hard to get rid of, because human beings, we have this tendency to do new things on and on. That growth tends to come from doing existing things better or from doing new things. For example, in the next few years, we may come to understand electric vehicles, even quantum computing extremely well, and every single industry that's been around for a long time, like transportation and consumer products, we may understand them so well that volatility could shrink massively with AI, et cetera, et cetera. But what will happen when the next growth industry becomes aerospace, in the sense of mining asteroids versus mining a mountain in South America or in Eastern Europe? That changes the equation. Now we have this big element where people don't know exactly what's going to happen. So I truly believe that there is always going to be an element of uncertainty in everything we do as humans, because we create that uncertainty because we bring new elements to the table constantly. So through innovation, which is I think if we were in some level of agreement in the last few minutes, with technology, innovation just gets faster and easier. So that in itself means there are always new things that we'll have to deal with uncertainty.
That's fantastic. How can people find you?
I would encourage people to visit my website. It's juanespinoza.com. And that's where you can keep up to date on what I'm working on, mainly on J fundamentals. And I'm also on LinkedIn, very easy to find. And I'm very excited about building this digital product for analysts. And it's a way for me to give back to the industry and hopefully to help people have even more enjoyable careers than the one I had.
Awesome. Well, thanks for coming on.
My pleasure. Good to see you, David.